Hello, I'm Shaun Richards of Not a Yes Man's Economics, and welcome to what's now, I guess, half lockdown London. Subject I want to look at today is the issue of central banks, which I return to quite a bit, basically because they're doing so much. I'm not sure that one could have imagined they'd go this far. And let me give you an example from what's happening at the European Central Bank. Now, this has moved forward in various ways through this crisis. You may not be aware, but let me give you a signal. It actually now has the lowest interest rate that we've seen through the credit crunch era, -1%. You may not have seen that publicised because to some extent it's quite technical and it's offered for the banks. Lords of the Ring fans will know that I use the phrase, my precious, to cover this. Central banks are always desperate to keep the banking sector going. It's a type of regulatory capture, really. They're full of bankers. It's their first priority. Returning to the interest rate issue, the ordinary rate in Europe for the likes of you and I or a business is -0.5%. But banks have been given the ability to access cash at -1%. This is because, ironically, although interest rates were cut to help the banks, they then find themselves in a situation whereby they're terrified of imposing it on you or I in general in case there's a run on bank deposits, which would expose some of their weaknesses. Coming back to the ECB now and looking at other areas, it's now thinking of what else can it do, because things are not really working. If we look at its inflation target, over the last decade, it's been well below it at 1.3%, in spite of making a lot of effort. Negative interest rates I've just discussed, you've got negative bond yields, spent nearly 3 billion in buying European bonds. So it's thrown a lot of ammunition at this, but it's not really working. So it's now moving into other areas. For example, it's bought corporate bonds. It's bought other bonds before, but at the minute it's now buying more. It's also considering moving into bank lending. This is really rather awkward on many fronts. For a start, should a central bank backed by the taxpayer doing this? But then there's also the issue of what is another form of bankers saying that they can do better than what the banks are doing now. Now, why would this be true? In essence, the gain is here, is getting the taxpayer to back it. And in a way, they can do that because, in general, taxpayers wouldn't understand what's happening here, would probably trust them and let them go on for a bit. But how does this work? Danger is, as we've seen in other projects, that the unscrupulous get in and there's a rise in fraud claims, as we've seen in some of the cases for helping people out with their incomes, helping smaller businesses, larger businesses, and so on. Also, if we look at what they do tend to do, it helps big business. Buying corporate bonds has to be that sort of size of company to benefit from that. Otherwise, how do you issue a €1 billion bond or 500 million euro bond? For most small firms, that's just the element of dreams, isn't it? And then there's another potential stage for which they can move into, and they're now looking at, if we look at the words of the governor of Bank of France yesterday, and this is possibly buying equities or shares. Now, this has all sorts of worms in the can. For example, who's responsible for this? Who decides? Who thinks it does any good in the first place? If we look at the case of Japan and its equity market buying, there's no clear thing it's made things better. And if you look at the situation in Japan, there's some fears it's made it worse. It's rolling companies on that maybe should have found. So as you can see, there's a lot going on here and a lot of interference in other areas. But if you want to take the red pill, well, equity markets are surging again. Let's see what happens next. Thank you.